$300 silver by 2027. I know exactly what you just thought. You thought, here we go, another YouTube thumbnail with a massive price target and zero substance behind it. Another silver hype video dressed up as analysis. I hear you. I've thought the same thing watching other people's videos. So let me say this right at the start. I am not going to ask you to believe anything I can't show you the math for. Every single number in this video comes from publicly available sources that I'll name. Every calculation I make, I'll do on screen so you can check it yourself. If the math is wrong, tell me in the comments. Show me where I've made an error. I genuinely want to know. Because I'm not here to sell you a dream. I'm here to show you what the numbers actually say when you follow them honestly to their conclusion. And when I do that, when I follow the data honestly, using nothing but publicly documented figures and basic arithmetic, the number I keep arriving at is somewhere in the $250 to $300 range by 2027. Not as a fantasy, as a logical outcome of conditions that already exist. Let me show you why. I'm the Silver Rabbi. I track precious metals markets every day, the data, the history, the mechanics. Today we're going deep on the math behind the silver price. Grab something to write with. Let's go. Before we talk about where silver is going, we need to agree on how to think about what silver is actually worth. Because this is where most price predictions fall apart. They start with a conclusion and work backwards. I want to do the opposite. Start with first principles and see where they lead. Silver plays two completely distinct roles in the modern economy. Role 1. Industrial commodity. Silver is consumed in manufacturing, used up, destroyed, gone. It goes into solar panels, circuit boards, electric vehicles, medical equipment. This consumption creates a demand that has nothing to do with investment sentiment. Role 2. Monetary metal and store of value. Silver has functioned as money for 5,000 years. It is held by investors, central banks, and ordinary savers as a hedge against currency debasement and financial instability. Each role has its own pricing logic. And what makes the current silver situation extraordinary is that both pricing logics, the industrial one and the monetary one, are pointing at the same conclusion simultaneously. Let me walk through each one and show you the math. Let's start with the industrial pricing logic. Step by step, because the arithmetic is simple and the conclusion is alarming. Step 1. Current supply and demand. According to the Silver Institute's 2025 World Silver Survey, global silver demand stands at 1.12 billion ounces in 2025. Mining supply is approximately 813 million ounces. Add recycling of approximately 193 million ounces, and total supply reaches around 1.006 billion ounces. That is a deficit of approximately 95 to 117 million ounces, depending on the source. Fifth consecutive year of deficit. Over the 5-year period from 2021 to 2025, the cumulative deficit has reached approximately 820 million ounces. That is nearly a full year of global mine production simply consumed and gone. Step 2. Project demand forward to 2027. The International Energy Agency projects global solar capacity to grow at a 17% compound annual growth rate through 2030. Each gigawatt of solar capacity requires approximately 20 to 25 tons of silver in panel manufacturing. Next-generation TOPCon solar cells, now the dominant architecture, require 50% more silver per panel than previous technology. Electric vehicle production is projected to surpass internal combustion engines as the primary driver of automotive silver demand by 2027, with EVs consuming 50% more silver per vehicle than conventional models. Total projected silver demand by 2027 is estimated by analysts to exceed 1.2 billion ounces annually. Step 3. Project supply. Total global mine production in 2025 stands at approximately 813 million ounces. The pipeline of new supply coming online before 2027 is limited. Major silver mines take 7 to 10 years from discovery to production. Industry analysts project 2027 mine supply at approximately 835 million ounces at most. Add recycling, and you reach perhaps 1.03 billion ounces of total supply. Step 4. The gap. Projected 2027 demand of over 1.2 billion ounces minus projected 2027 total supply of approximately 1.03 billion ounces equals a deficit approaching 170 million ounces in a single year, on top of the 820 million ounces already consumed from above-ground stockpiles since 2021. Now apply basic commodity economics. When a physical commodity runs a structural deficit, the price must rise until either demand is destroyed or new supply is incentivized. For silver, industrial demand is largely inelastic. You cannot easily substitute silver in solar panels or medical equipment. The price has to move a long way before industrial users reduce consumption. The all-in sustaining cost for primary silver producers currently averages approximately $16 to $18 per ounce for the lowest cost producers. But the marginal producer, the one whose output the market actually needs to function, sits at $22 to $28 per ounce. The incentive price required to develop new primary silver mines historically runs 2 to 3 times the marginal AISC. That gets you to $44 to $84 per ounce just to incentivize new supply. And silver is already trading at $79 today, meaning even at current prices, new mine development is only barely economic for the marginal producer. For the deficit to actually close, prices need to go substantially higher. That's from the industrial logic alone, and we haven't touched the monetary argument yet. Now let's look at the monetary pricing logic, and this is where the $300 number becomes not just plausible, but, and I use this word carefully, mathematically conservative. The gold-silver ratio. Right now it sits at approximately 60 to 1. That means it takes 60 ounces of silver to buy 1 ounce of gold. Write that number down. The historical average gold-silver ratio, measured across thousands of years of monetary history, is approximately 15 to 20 to 1. In the ground, silver is found at roughly 10 to 15 parts for every 1 part gold. For most of recorded human history, their prices roughly reflected that natural abundance ratio. The current ratio of 60 to 1 is historically extreme, and stretched ratios have a tendency to revert toward their mean over time. So let's run the numbers. Gold is currently trading at approximately $4,800 per ounce. If the gold-silver ratio reverts to just 40 to 1, not the historical mean of 15, not even close, just 40, silver would be $120 per ounce. If it reverts to 30 to 1, silver is $160. If it reverts to the historical mean of 15 to 1, silver is $320. None of those calculations require anything exotic. None of them require silver to do anything it hasn't done before. They simply require the ratio to normalize, partially or fully, toward where it has historically traded. And at a gold price of $4,800, even partial normalization to 40 to 1 produces a silver price of $120. Reversion to 30 to 1 gets you $160. The historical mean of 15 to 1 gets you $320. That is where the $300 number comes from. It is not a hope. It is arithmetic. And notably, silver's own all-time nominal high was $121.67, set on January 29, 2026, which means $300 is not even double the level this metal already touched earlier this year. There is a third mathematical framework I want to walk through. It's the relationship between silver's price and the money supply. In 1980, when silver hit its previous all-time high of approximately $50 per ounce, the U.S. M2 money supply stood at approximately $1.6 trillion. Today, M2 sits at approximately $22.4 trillion as of January 2026, the most recent Federal Reserve reading. If silver had simply kept pace with money supply growth, not outperformed, not had any speculative premium, simply maintained its purchasing power in dollar terms, it would be trading at approximately $700 per ounce today. That is the M2 adjusted equivalent of the 1980 high. Silver at $79 represents approximately 11% of where basic monetary math says it should be if it had done nothing but keep pace with the dollars printed since 1980. Put another way, silver at its current price is cheaper in real money supply adjusted terms than it was at any point between 1978 and 1982. The last time silver was this undervalued relative to the money supply, what followed was one of the largest silver price moves in modern history. Three separate mathematical frameworks. Industrial deficit math points to prices well above $84 just to incentivize marginal supply. Gold-silver ratio math at 30-to-1 reversion points to $160. Money supply adjustment suggests $700 as true fair value. They are not identical numbers, but they are all pointing in the same direction, dramatically higher than today. And $300 sits comfortably below all three of those numbers. That convergence is not coincidence. 300 is not the ceiling. It is a reasonable midpoint between where we are and where the math actually points. Now let me tell you exactly why this might not happen, because you deserve the full picture. First, markets can be irrational for longer than you can stay solvent. The gold-silver ratio has been stretched above historical norms for decades. People have been making the bull case for silver for decades. Being early in this trade is the same as being wrong until the moment it isn't. Silver's own nominal all-time high of $121.67 was set just this year, in January 2026. And even that represented only a fraction of monetary fair value. Being right about the destination does not protect you from a brutal journey. Second, technology risk is real. If a breakthrough substitute for silver in solar panels or semiconductors is developed, the industrial demand thesis weakens significantly. So far, no viable substitute exists at scale, but so far is not the same as never. TOPCon cells increase silver demand per panel, but the next generation after that could theoretically reverse that trend. Third, a severe global recession, or an escalation of current geopolitical stress, such as the ongoing Strait of Hormuz situation, would likely take silver down sharply in the short term, regardless of fundamentals. In 2008, silver fell 50% in a matter of weeks as institutions liquidated everything to raise cash. The fundamentals were intact. The price didn't care. Silver has already pulled back roughly 15% from its January 2026 high due to the current Iran war and its inflationary implications. Fourth, and this is the hardest one to say, I could simply be wrong in my reading of the data. I've been wrong before, and I will be wrong again. Please do your own research. Use my work as a starting point, not an end point. So why am I still standing here telling you $300 by 2027 is the mathematical conclusion? Because the frameworks I've shown you are not my opinions. They are publicly available data and basic arithmetic. You can run these numbers yourself tonight. The Silver Institute publishes its data publicly at silverinstitute.org. The Federal Reserve publishes M2 data publicly at fred.stlouisfed.org. The gold-silver ratio is live on goldprice.org right now. Everything I've shown you today is sitting in plain sight, available to anyone with the patience to look. In the Passover Haggadah, the story Jews read every year at the Seder table, there is a phrase that has stayed with me for as long as I can remember. In every generation, each person is obligated to see themselves as if they personally left Egypt. What that means is, don't treat history as something that happened to other people. Treat it as something you were living through. The lessons aren't archives, they are instructions. The lesson of monetary history is not ancient. It is not theoretical. It is being written right now in the Federal Reserve's balance sheet, in the national debt clock, in the purchasing power of the dollar you earned this week compared to the dollar your parents earned in 1971. The debasement is not coming. It has already happened. The M2 money supply has expanded from $1.6 trillion to $22.4 trillion since 1980, a 1,300% increase. Silver has not kept pace. The gap between where it trades and where the monetary math says it belongs is not getting smaller. It is getting larger. And gaps that large in commodity markets with physical supply constraints do not stay open forever. $300 is a number. The number matters less than understanding why the number is mathematically reachable through three completely independent lines of reasoning, none of which require anything other than trends that are already in motion to continue. You don't have to believe me. You shouldn't believe me. Go run the numbers yourself. The Silver Institute publishes its data publicly. The Federal Reserve publishes the M2 data publicly. The gold-silver ratio is live on any precious metals site right now. Everything I've shown you today is sitting in plain sight, available to anyone with the patience to look. Subscribe if you want to keep following this analysis. I do this every single day. Tomorrow we're going to look at why $150 silver is not the ceiling, it's the floor, and I'll prove it with the same methodology we use today. You don't want to miss it. I'm the Silver Rabbi. The math doesn't lie. I'll see you tomorrow.